Mhm. Hello, everyone. We have the lecture 7, and it's very important lecture. One of the most important in this course, because on this lecture you can see how to construct, no, maybe pure theoretically, but okay, how to construct a riskless portfolio and how we can deal trading without risk. So let's get started. But previously on stochastic financial mathematics, you remember that we set the main goal, and its goal to model financial market, the dynamic of financial market. We assumed that financial market consists at least of three components, and it is a riskless asset, risky asset, and derivative. For a riskless asset, everything is clear, and it's the lesson 1. For risky asset, we choose the geometrical Brownian motion, and the dynamic for this is described like this stochastic differential equation, where you see that W sub t, it's Wiener process or Brownian motion. What is this process? What are its properties? You need to know, but we repeated this on every lecture, so please, it is by yourself. So we have a stochastic differential equation. We know how to solve this equation and what is solution of this equation. So we know everything according to this component, risky asset. What is about derivative? What is about derivative? For derivative, we formulate eta lemma, and we know how calculate differential from f, where f is pure function of derivatives. For us, we chose the call option. So f is pure function for call option. Okay. Maybe you can remind me and say now how I can write what is your function for call option. Karina,
I don't remember, to be honest.
you don't remember, but you understand my question, yes? So we have we have call option. You know what is this, yes? Yes, it is like security, and at the end of maturity, we can pay function. And what is pay function? Maybe Katya?
Oh, sorry, I just joined, so I'm a little bit out of context, so I need some time. Sorry.
Okay, Nastya. Pay function. Or definition of call option. No, what do you know about call option? Nastya? No, yes. Okay, Fedor.
About wave function,
Yes.
it's maximum between 0 and the price of active minus strike. That's all.
Okay.
Like S in time t minus k.
So for call option, so for example, we have stock prices. stock prices. It's like only one realization, and it is the S at the time T, where T is time to maturity. So for example, we bought call option for 3 months. So T equals 3 months, okay? T equals 3 months. But now we in this point, and we don't know about this trajectory, about shape of this trajectory. Maybe this, maybe this. No, for example, it's like for example. But when we buy call option, we need to point strike price. Strike price. For example, and this strike price denoted like K, little k, and at this time maturity, by your function, it is this S minus K. So if we can guess that S will be more than K at this moment, we win. If we don't guess, we lose. Understand? Hmm? Understand? No? Nastya, do you understand now about PIO function, call option,
Yes.
and
Yes.
yes, okay, and
Yes, it's clear.
about this motivation, it's clear. Okay, thank you. So, uh, okay, so f is some PIO function, no, of call option or of any other derivatives, and if we know the stochastic differential equation for S, and f it is some function, no, in our case it is a function maximum, but it can be other function, yes. So using lemma eta, we can write a differential from this PIO function, and it's according lemma eta. Okay. After that, we built the riskless portfolio. It was on the previous lecture. Portfolio is just a vector with some coordinate. If we have 3 securities, it is a vector with 3 coordinate. In our case, we have the portfolio only with 2 securities. So it is a vector with 2 securities. And the first coordinate is amount of option, and the second it's amount of stocks. And you can see, we don't know how much these derivatives df respect to ds, but it is exactly material for today's lecture. Anyway, so we have to coordinate, and you see that the first coordinate with minus and the second with plus. What does it mean? Do you know, Fedor? What does
Can
mean?
you
What does mean
repeat?
minus and plus in portfolio? What does mean minus and what does mean plus in portfolio? You don't know, yes?
Don't remember.
Don't remember. Okay. Don't remember. And Nastya, don't know, yes? Nastya
Yes.
doesn't know. Okay. Okay. So minus means sell, to sell, and plus means to buy. Okay, so in our portfolio we can have securities which we or buy or sell. And if we, for example, have portfolio with coordinates 2 and 5, so it means that we are going to buy two assets for example, company A and 5 company B. And if we know that the initial price, price for today for company A 100 euros and for company B 200 euros, so we can compute the value of portfolio, and this value of portfolio will be, Nastya, how much? In your portfolio, two assets of company A and each 100 euro, and 5 company of company B and each is 200 euros. How much value of portfolio?
Minus
Without minus.
two.
Yeah, without.
Okay.
This with plus and this with plus and this with plus.
Okay. Then 200 plus
Yes,
1000.
plus 1000. Yes, you're right. Plus 1000. Okay, so now we repeated what is portfolio and how we can compute value of portfolio. Yes, but in our case, we have don't 2 and 5 amount, yes, company A and B, but minus 1, it is for call option, and this amount, it is instead 5 for stocks. So now we multiplied how much the call option by the price of call option, but price of call option is by your function. You already know this, so it's F, and price for stocks, assume that S. So it is value of portfolio. And at the previous lecture, we stated that this portfolio is riskless. Before if we use exactly this portfolio, so the two differential equations which describes risky asset and call option are without a random component. No, but it's you can see detailed the previous lecture. Okay. So now we assumed that the change of this portfolio from previous slide proportion the value of portfolio R at delta t, and we obtained this celebrated Black-Scholes partial differential equation. It's material of the previous lecture too. And you see that it's it is just stochastic, not stochastic, but just differential equation. For a solution, we need to know boundary condition, and it is like by your function, and we repeat it now. Yes, you remember Feder said about that. Yes, it's the function maximum between this and this. Okay, so in this way, we arrived at the Black-Scholes formula. According to this formula, we can compute the fair price of call option. On the site, for example, on the NASDAQ, this fair price, theoretical price, is called premium. So we can compute premium. The questions about this model is what happens with this price C if one of the input parameters changed? Understand questions? Again, maybe. In this formula, we have some parameters. What are these parameters? The first parameter, it is S. S, it is price, stock price for today, S. The second, K. No, you remember, I draw you that it, for example, S, yes. So today it is S, at this time it will be S sub t. S sub t we can compute, so like parameter we need only to know only S. So S it's first parameter. Next, when we buy the call option, it is necessary to choose K. So K, it is strike price. It is the second parameters. The second parameters. Time maturity to maturity, T capital. It is the third parameters. Third parameters. R, it is interest rate. It is the first parameters, and sigma volatility, it is the fifth parameters. So we have 5 parameters. Do you understand? Is it clear? Настя?
Yes, yes.
Yes, five parameters. If we know these 5 parameters, we can open Python and library Mibian, and using library Mibian very quickly to compute the C. It is premium for call option or premium for put option. And everything is okay. But the question, what happens if S, for example, we compute all this for S equals 100, but if S is 101, how change this S? Or if R for today 5%, but for tomorrow we predict them 5 and 5. How this changed? So you understand, yes? The question. The question. Okay. So it's called sensitivity of model. Sensitivity of model, it means that we learn how changed the fair price or no, the value of model if we change the value of parameters. Okay, and this change of parameters we called by Greek letters, and we not by Greek letters, and we called Greeks. And each Greek letter or each Greeks measures at a different dimension to the risk is an option position. So all that you can see on this differential Black-Scholes differential equation, it is like, for example, derivatives f respect to time. Yes, it is, in fact, it is change, yes, change of Pio function respect to change time. This it is df respect to ds, and this is the second derivatives, and can be other derivatives. So you can see the table with this Greek. It is from Wikipedia. And it is the Greek letter, delta, gamma, vega, theta, rho, and it is, what does it denotes? And we need to find out how to how to compute this. For example, how to compute delta. The answer is this, but how we can obtain this answer? Yes, do you understand? Okay, so I think that you understood that delta is the rate of change of its price with respect to the price of the underlying asset. Yes, okay. Okay. So delta. Nastya, how you can comment, interpret this? Delta, it is delta is rate of change price optional with respect to price of underlying asset. So what is the derivatives? D and respect to D, what I need to write to this? Delta is the rate of change, its price. Its price means price of option. Price of option, how we denote? S, C,
S.
yes, C,
C. Mhm.
S with respect to the price of underlying asset. Underlying asset, it is
S.
stock price. Yes.
Mhm.
So exactly. So delta, it is this. Gamma, it is rate of change delta with respect to S. So it is gamma, it is the second, no, it is derivative of delta, or the second derivative, this, yes. So gamma, no, it is can be little, or it can be capital. So it is the second derivatives, yes, second derivatives. Vega, it is respect to volatility. So it is derivative ds, but respect to not to ds, but to sigma. Yes, understand? Okay. And now I need to show you how to compute, how to derive a formula for a delta. And it's like some steps. The first step. We know D1, D2, it is from Black-Scholes formula. And first step, we need to compute derivatives from D1 respect to ds. So we need to compute these derivatives respect to s. You see that it is the first term, it is the second term, yes? And we need to compute this derivative. These derivatives. Nastya, derivatives from this will be how much?
I need some time to think about.
Okay, but okay, please take a look. It is derivatives respect to s. So if you would like to find derivatives respect to s, respect
0.
0. Okay, so it is 0.
Mhm.
It is 0. So we need to find only derivatives from this. Um, this, it is like coefficient, yes?
Mhm. Yes.
Sigma s we don't have. So we need to just to find derivatives from log. Do you remember derivatives from ln x?
1 divided by x.
Yes.
No.
It will be 1 divided by x, yes? 1 divided by x. So in our case, derivatives from this log, it is 1 divided by this ratio. It will be
Mhm.
k divided by s e, no, to the power, no, this power,
Mhm.
yes?
Mhm.
Okay, and but it's not simple function, so we need
Mhm.
to use
Multiply.
yes, multiply e what multiply, please?
E in power r 10 minus
Yeah.
10.
Yes.
Yeah.
And
Divide by k.
yes, you're right. So it crossed, and only remained 1 divided by s.
S.
Okay, so it is, you can see it is this coefficient and derivatives 1 divided by s. Yes?
Mhm.
And for d2, it is the same because this derivatives is 0 anyway.
Mhm.
Okay, thank you. Mhm. The second step, or Elena, the second step. We need to find derivatives from C respect to S. C, it is fair price, it is this formula, it is, no, formula, Black-Scholes formula. So you see the first term and the second. If we take the first term, it is like product, yes? First and the second. If we find the derivatives from S, it is 1, yes? 1 derivatives by n plus S multiplied by derivatives n from d1, because d1 depends from S. You can see in the previous slide, yes? And minus k, no, it's without s, so it is like coefficient and multiplied by derivatives from n and these derivatives. Okay, these derivatives and these derivatives we already found on the previous slide. So we can write it as like before brackets, and in the brackets we can this. Okay, it was the second step. This was the second step. Now we need to notice about these derivatives, because if n it is if it is the distribution function, so the derivatives, it is like density, yes? And you know this function. Normal distribution, n it is normal distribution, phi it is density function from normal distribution. Okay. No, you see that we need, yes, to apply to this end, so we noticed. Okay. After that, it is very useful to compute d1 plus d2 and d1 minus d2. First, d1 and d2 you need. And what is d1 plus d2? If we found the sum of this, and you see that this term and this term are the same, only with different signs. So the result will be like 2 to this, yes? But the difference between D1 and D2, the first term is the same, so we have only the second. Okay, and after that we can find the difference of the square from D1 and D2. Can you say how we can find this result? If we know this and this. Elena, can you say?
Oh, we can just add them. Yeah.
Add.
And divide. I think, yeah, we have to divide and integrate. Yeah.
No. Do you remember
Oh.
this formula?
Oh
Difference.
yeah, we have the difference of squares. Yeah, it's multiply them. Sorry.
Yes, you're right. Thank you. So we need just, oh, sorry. So you need just multiplied this and this. So it is this result, and we can write in this form this result. From this result, we can obtain this only this d2 if we move d1 squared to the right side. No, and after that divided by 2. Okay, so if we have this function, we write instead phi from d2, the function of a normal distribution, density function of a normal distribution, and after that we can replace d2 from previous slides. So after that k crossed, and we obtained this result. Okay, because it was on previous slide. So k multiplied e to the power phi from d2, it is like s phi from d1. So you have from previous slide that s phi from d1, it is this. S phi from d1, it is this. So the expression in the bracket is 0, yes? So we have that these derivatives is just n from d1. And it is the result from this table, n from d1, okay? So for delta, if you need to compute delta, you need only to find the normal distribution from d1. And how to compute d1, you know, yes? D1, it is expression from d1. Okay. All other Greeks we can compute similar. So it was like the first part of lecture, and now the second part, it is about the hedge, because this hedge will be connected with this with the riskless portfolio, and you remember that in the risk portfolio we can see these derivatives. dc respect to ds. Okay, but what you know about hedge? Have you ever been here about hedge? No? Before? Maybe Feder only, yes? No?
Sorry. The head is like
Oh,
invested.
the sound isn't good. Mm-hmm. No.
Hedge
Uh-huh. So hedging is a way to get portfolio protection.
investigations that decrease the risk of
Yes.
changing the price factor.
Yes. So no, something like this. Yes, really. So if we buy some asset, we need, for example, to buy or to sell other security, other asset. Yes, and it is like this way to protect the risk. But before, let me explain you this in terms of example. And first, I need to show you what is called naked and covered position, because it is clear that naked position, it is position without protection, it is without hedge, yes, but covered position, it can be like hedge. Okay, so let's consider an example, the position of a financial institution that has sold European call option. Maybe I need to stop at this and explain that if you buy call or put option, it is a long position, and you're waiting for the time to maturity, but you are sure that your loss will be limited. No, it is like you buy the lottery ticket, yes? No, if this lottery ticket doesn't win, it's doesn't matter. It's not something serious, yes? You know that your loss, it is the cost of the lottery ticket. Do you understand this? Okay, but if you sell, not buy, but sell option, you don't know you don't know if this win or loss, and your loss can be unlimited, because it's very important for financial institution exactly to hedge selling the option selling. So, and this example, so we sold European call option on 100,000 shares. No, shares, it's like stocks. And the price of this operation is 300 of thousands, okay? We assume that the stock price is $49. It is the strike price. What was pointed in the call option is 50. Risk interest rate, it's 5%. Volatility 20 approximately. Time to maturity 20 weeks. And what is part of euros? It is this part. And no, and for example, we know even expected returns. Okay, if we know all this data, we can compute the fair price of call option. No, maybe I can see even this. Oh, you remember? I already showed you that we have library MIBN, and for this library, what is price? Maybe it is this example. Yes, 49. It is 50. It is strike price. It is interest rate, and it is volatility. So we have that the theoretical call price is 2.4. Yes, but for put option, theoretical price of premium is this. Okay, so we return on our example. So this is a theoretical price, but we sold for this price, So it is like 60,000. It is difference, and it's good for us if we sold all this. But okay, but now our strategy is do nothing. It is naked position. Do nothing. Yes. So in the option trading, we do nothing, only sell the call option. And now we need to analyze this position. Okay. No, there are two scenario. There are two scenario. No, maybe I can draw it this. The first scenario. For today, 49 at the stock price, and time to maturity. There are two scenarios. Maybe the first scenario, it is that this realization is more than 50. More than 50. Because 50 it is strike price. K equals 50. K equals 50. So if it is more than 50, no, for example, no, 58. So you remember we repeated today, by your function it is this difference, yes, this difference, it is 8 by your function, yes, it's 8 in this case. It is not maybe this, it is this the second. Okay. Yes. So call option, it is for those who buy this option, but it's not we, because we sell this option. So it is by your function, and we sell 10,000. So it is loss for our company. So the first scenario, it is this, yes. First scenario, it is like we need to everyone who bought this call option give up this $8. So 8 multiplied by 10,000. 10,000 or 100. 100,000. No, so it is 800,000. But all these people who bought this call option, they paid how much? Everyone who bought. What was premium?
300,000.
3. Yes. 3 for $1, but yes, for every 300. So it is with plus and it's with minus. So the loss of our company, how much?
500.
Yes. Yes. Sorry. Yes, it is exactly. Loss is 500. There are other scenarios that we have this K 50, but the price is less than 50. Less than 50 at this moment. And it doesn't matter how much less, because if the price less, so you see that we don't have this S minus K positive, yes? We don't have. So anyone who bought our call option didn't win. It's called that call option cost nothing. And we, because you remember we are financial company, we don't need to repay anyone, but we have this 300,000. Yes, we have this 300 or 300 of thousand. It's our profit. So 300,000. So summary, if we have naked position and we do nothing, so there are two scenarios, and in one scenario we have profit with minus and maybe this, and in other scenario, if the price less than K, we have this profit. Okay. What is about covered position? What is about covered position? What does mean covered position? This mean buying 100,000 shares as soon as the option has been sold. So we just sold option and immediately buy 100,000 stocks. Okay. And we have two scenario too. Okay, the first, you remember, if stock price goes on over 49. But in this case, we have stocks and option, and we need to compute our profit, profit for trading stocks and profit for trading option. Okay, the first scenario, it is today we have 49, and for example, in the future, it will be 58, and our strike price, you remember, K is 50. K is 50. So payoff function for call option, Nastya, what is payoff function for call option in this case? Nastya.
58 minus 50.
Yes, you are right. Thank you. Correct. So this it is payoff function for those who bought this call option. But we financial company. Okay, so we need to compute first what is about stocks. What is about stocks? Stocks today it will be 49. At the time to maturity it is 58. So the profit on one stock, how much?
9.
9. Okay, 9. It is 58 minus 49. It is 8. Or 8, yes.
9.
Oh, 9, you said. Yes, okay. 9. And how much we have this 100,000, yes? 100,000. Okay. Oh, it is this. Yes, it is our profit on stock trading. It is this. But what is about option trading? We need the payoff function is 8, and we need to give off this amount. Yes. So it is 8,000. 8 multiplied by, yes, We promised, yes. And it is not like right, but it's obligation. Okay, so this 800,000, it's with minus. 9, it is with plus because it is our profit, but this it's our loss. And 300,000, it is our profit too because it is the money for buying our call option. And like result, in this scenario, we have the profit 400,000. Do you understand?
Yes.
Yes.
Yes. Thank you. Um, about the second scenario. Second scenario. Okay, maybe I draw. Today we have 49, you remember. Today we have 49. And at the time to maturity, for example, it will be 40. 40. So it's like this, 40. 40. And the K50. K50. What is about stock trading? What is about stock trading? We bought stocks for 49, but at this time its price 40. So it's profit or loss for stock. What stock? For stock price. Stock price drops at 40. But initial price for okay.
It's profit because
No.
we sell.
Не-не-не.
No, for us because we sell.
But now I ask you about stock because now it's
Okay,
covered
it's
position.
loss. Yeah, in stock it's loss.
Yes,
Yeah, I think you
yes,
say
I
about
understand.
option.
I understand. So we have first for stock we have loss. This, yes, we have this loss on stock trading. On stock trading. And what is about option trading? Yes, Fedor, the option cost nothing. Yes,
Yes.
and we have only 300,000 because no, charge it for the option. Yes. Okay.
Yes.
But you see that the summary we have our profit like minus 600,000. 600,000. So for first scenario we have profit, but for the second scenario we have loss. Okay, and so what we have said summary that neither naked position nor a covered position provides a good hedge. Yes, it's not free. It's not free. If we are going to use Black-Scholes formula and Black-Scholes strategy for constructing a riskless portfolio, so this strategy cost close to 240,000. And it will be later today, but maybe about other hedging strategy. It's called stop loss strategy. Stop loss strategy. It is this hedging strategy involves buying one unit of stock as soon as the stock price rise above K and selling if below K. No, it can be this. So we observed. Yeah, first we need to fix some K, and after that we need to observe when the price more and where above K, and very quickly to buy or to less our stocks. Understand? So it is like covered position. We sell our call option too, but if in the naked position we do nothing, and if in covered position we immediately buy 100,000 of stocks, in this case we don't immediately buy 100 stocks, but we buy and sell these stocks according this graph. But this strategy doesn't work well too, because it is often impossible to buy or to sell very quickly, and there are some other reasons. So and now I propose you other hedging strategy. It's called dynamic delta hedging, and this dynamic delta hedging is based on the Black-Scholes model, and how they build a riskless portfolio. And you remember that this riskless portfolio, it was this, yes. So Black and Scholes propose that the riskless portfolio can be in this form. We sell one call option, and we buy the stocks, but in this amount. But how we can compute this DFDS? It is delta, so it is delta, or it is delta, so it is n normal distribution function from D1, but it is on only a short term, so it is like combining this strategy with this strategy. Now I will show you. Okay, so this portfolio minus delta and plus 1. Okay. Okay, now we know all this, that we have the price for today 49 stock price for today, and we chose the call option with price 50, and now we would like to hedge this selling by delta hedging. And I would like to notice that this strategy is good even without option trading. For example, one my student told me that he needed to write the program algorithm for automatically trading by currency. It means that if the currency is go down, what the company need to do, to buy or to sell? If to buy or to sell, to how much? And so on. So image please that the stock price or currency, for example, for today is 49. Okay, do you understand? And for example, we have 20 weeks for this hedging, 20 week. After that, we need to fix something price. It is like strike price, but even we don't have option, we need to fix this. It is like this strike price. And after that we can observe more or less than this strike price. So, and our strike price it's 50, for example. So our first step it is to compute delta for this stock price. You remember that delta is delta it is the function of normal distribution for D1, So we compute delta and it is 0 point this, okay? And according to our algorithm, it means that we need to buy, for example, we would like to have 100,000 stocks. No, because in this example it is given 100,000. So we multiplied our delta by 100,000, and it means how much stocks we need to buy at the first moment. It's like a first step. Do you understand this? The first step of algorithm? No?
Yes.
Yes. Okay. In this, we can compute how much we need to pay for this. So it is like 50 tam to ta ta ta. It is how much, and multiplied by stock price, and it is this amount. And we assume that we don't own any money. So all this money it is with debt. So we need to pay for this debt. So it is our cumulative debt, and we need to pay interest rate 5% of 1 year. So for 1 week it will be this. Okay, this part. So we multiplied. No, we multiplied this interest rate by this sum, and it will be 2.5. So at the end of the first week we need to pay this. Okay, the second week start, and you can see that the price less than 49. Again, we compute delta, and it will be another value, because what change the stock price and change the time to maturity. Yes, time to maturity for this it will be 20 weeks, but for this it is 90 weeks. Okay, after that, the second step, we need to find the difference between this and this. And you see that it is a negative value. Yes? Oh, negative value. This minus this. And I don't see where I write it, but okay. It is a negative value. It will be 0.64 with minus. And to be multiplied by 100,000, and minus means that we need to sell this amount of stocks. Yes, the price dropped, but we need to sell not all stocks, but only this amount, according to this delta, even not delta, but difference from this delta. After that, we change our cost, because it is like our debt, but plus this 308 300. How we obtained 308? We multiplied the difference by 48. Okay, and after that, no, we need to pay for debt and so on. Or maybe I write all this cumulative interest cost. Yes, and what is summary at the end of this 20 weeks? We need to have a look. What is about delta? You see that delta will be one, and this shares is 0. We need to buy or to sell at the end. And this picture will be if the stock price at the money. So if this more than 49. So more than 50 even. At the option closes at the money, and the stocks it is more than this. So we can say that during 20 weeks the investor bought 160 and sold this amount of shares. Why? We can just to add with plus, it is without bracket, and after that to add with minus, it is with bracket, and it will be that bought this amount and sold this amount shares. So at the end he owns 100,000 shares, and the price is 57. So his profit is, no, it is like at the end, and it is he paid at the start. So for shares he has this sum. No, it is this. Yes, because all this all money it was debt. Okay. It's his profit in stock trading, this. Okay, so if you need to trade only currency, only by currency, so it is like this. But if you have possibility to trade by option 2, so as holder of call option he must give out this sum. But because it was the stock price more than strike price, but he earns premium, so it is lost in option trading. But the summary profit this. And even if we considered other scenario when the stock price is out of the money, so we will be the profit. So it's a very useful strategy, and approximately it cost this. It is like according the fair price of call option, and maybe the we out of the time. Okay, and on the practice we can see this in more detail. Okay.
Okay.
So see you at 3 p.m.
Okay.
Okay, thank you for your attention.
Thank you.
Thank you.